everybody's connected. All right, and we are recording. Okay, folks, it is September, and we are talking July statistics. So please keep in mind, let's keep the conversation to the director's cut, and I will be happy as can be. So I don't have any other notes as far as that. So, Mr. Helms, take it away.
All right, thanks, Allison. We certainly want to try to make you happy. Welcome to our September webinar, and we're talking July production. So I'm happy that you have come to the webinar or tuned in. I've got really 10 things that I kind of want to touch on, and that led me to the theme which we've been discussing here in the room. I'm calling it hanging 10. There's a thing that folks do when they hang 10. It's a surfing expression, and it's a Hawaiian word called shaka, and it's not. Please don't confuse it with go bison, which looks like this. But interestingly enough, they say it's one of the hardest maneuvers there is. And I know some folks who have surfed in Hawaii. Young people actually get to take it for Phi Ed out there, but you have to find the right wave, and generally it's a pretty big wave. You got to be on a long board, you got to balance it perfectly, and then you just try to keep everything together, and that allows you to hang 10. And that's really what it looks like industry is doing right now. Oil production up 0.2%, so just essentially flat. And I think we were really expecting there might be some decline. It still is in the works. There were enough completions of enough good wells, roughly 41 completions of some extremely good wells that allowed industry to maintain production above 1 million barrels a day. And I think psychologically that's a significant number. So we're still well above 1 million barrels a day, a month or two above it, even if we have some pretty good declines. Gas production, again, up significantly, 2% increase in gas production. And just a little increase in the number of wells producing, only about 7. So again, everything is just kind of staying in balance. Permitting is up, but that's normal for this time of year. It's nowhere near what it was in the peak. It's about a fourth of what it was in the peak. But there's a little bit of positioning on the part of industry to prepare for fall and winter weather and get their pads and permits approved. So they, once the crop comes off, they can do their construction with the least amount of interruption of agriculture and the least cost. Rig count, pretty flat, up 1 from a month ago at 33. And really kind of the same in terms of wells waiting on completion. It's only up 25. It's a little over 900. Pretty much the same story in terms of rigs operating on federal lands, went from 0 to 1. Same on Fort Berthold, went from 6 to 7. So they gained 1 rig on Fort Berthold, and that happened to be on fee lands. And even when we get down into the flaring business, you're looking at a very small change, up 0.7%. So it went from 9.8% to 10.5%, and a very slight increase in the flare daily volume. And even on the federal aspect, where we're tracking a lot of federal rules and activity, not much happening there right now in terms of new rules or activity on the state's part. We've filed, in some of the litigation that we have going on, we filed some motions and some briefs. We are still analyzing a couple of items, for example, the sage grouse document and the Scientific Advisory Board's document on hydraulic fracturing, but not even a lot of activity going on there. So again, just pretty steady, which if you were a surfer hanging 10, you'd be totally happy with that. So I had 10 things, and that just seemed like the right theme. Shaka.
Okay.
So we'll take some questions if we have some. So the question was, what do I hear from companies about preparing for colder weather? And I sat down with a couple of hydraulic fracturing experts I actually had the opportunity, I guess it was a week ago, to be up in Williston when some folks from the UK and the EU were there, and all of the hydraulic fracturing companies were there, along with a consultant that works in that business. At that time, we counted 10 frac crews, and they were saying they anticipate over the winter going back down to 5. So anticipation is that we'll stay at this low completion number, or actually maybe drop off some as we go through the winter. So I still think that the revenue projection that was put together based on 900,000 barrels a day is pretty realistic. I think we're headed that direction. Hearing the same thing about drilling rigs, I know that we saw an increase. We got as low as, I think, 26 at one time. We've been as high as 37 recently. But the drilling companies and the operators are saying they're headed back for around 30 as we go into the winter. So just the minimum amount of capital expenditure that they need to make in order to maintain or even allow production to decline a little bit.
There's been some word that OPEC may try to step in and try to ratchet things back for the full study. Have you heard anything more about that?
The question was the OPEC meeting that's yet to come this month, and their efforts to maybe hold production steady so that we can work through this world oil glut. I did just yesterday hear that kind of the same old tune is taking place, that Saudi Arabia, Russia, the other OPEC nations very interested, Iran not so much. Iran still would like to build their production to at or above the pre-sanctions production levels, and they're 500,000 to 1 million barrels a day short of that. So there'll be some discussion of it this month, but I think the possibility of it actually happening is diminishing as it gets closer.
Probably along those same lines. So there was news about oil supply being sufficient to last through 2017. Do you think that'll have any impact on North Dakota?
Great question, and yes, I do. I think a number of things are happening. The price weakness clearly indicates that there's enough value in the oil to keep wells on production, probably continue to work over wells and put broken wells back on production. There is not enough value to mobilize frac crews, and certainly not enough value to mobilize drilling rigs. And it looks like U.S. inventories and world inventories are adequate to keep this price level in place through the end of this year. So there were some very hopeful and optimistic people that thought we might see that $50 number in the third quarter of 2016. It's pretty obvious it's not going to happen. And I think the numbers are lining up to say it's not going to happen this year. So even if we hit that number in the first quarter of next year, North Dakota-wise, the weather will be so bad, likely, that we won't see any real activity till probably second quarter or towards mid-year.
Okay, so the next question, which actually these came in very first at the exact same time, of course, do you still expect production to fall below 1 million barrels a day by the end of 2016?
Yeah, so I do, in fact. We still have, these are July numbers, so there's still 5 months of production to come in between now and when we're done with 2016. And we're really only 1 or 2 months decline away from that million barrel a day number. So I know psychologically that's going to send an interesting signal to the market, but I really anticipate that by the end of the year, we're going to be below 1 million barrels a day.
Did you have something else?
Yeah, I just to follow up with the price points, the 50 for also come back on $60 per freight, I believe. Since they didn't see it this quarter, and you said the first quarter they might not, are they going to readjust maybe that price point, maybe a little lower if it's not really becoming realistic?
Great question. So the question was, is industry able to adjust that price point or drop it down in response to what's happening in the market? Actually, what we've been seeing is North Dakota operators making deals in other basins where those price points are lower. So, for example, EOG just purchased Yates Petroleum, which gave them an enormous position in the Permian. And earlier we saw Continental Resources shift capital expenditures to the SCOOP and the STACK in Oklahoma. We also saw QEP make a similar move to buy into the Permian. So not great news for North Dakota in that what we're actually seeing is capital reallocated to particularly the Permian and also Oklahoma, where those price points are already lower. And that's an easier thing for them to do. It really looks like they have reduced costs as much as they can, that they've gotten the completed well costs and the operating costs as low as technology allows for at this point. And so it's unfortunate. It would have been great to hit that price number in the third quarter because that's when they do their budgets. All of these companies, or dominantly, the vast majority of them, will set their 2017 budgets around the 1st of October, the first month of the fourth quarter. So it really matters what price you're at in the third quarter, and we're just too low.
Are we seeing any kind of pullback on infrastructure build-out as well? I've kind of had to put access in mind as well. Are we seeing any kind of pullback on infrastructure build-out in any way? Along with that as well?
So the question was infrastructure pullback, and I'm going to speak not to Dakota Access because that's outside my wheelhouse, but I want to talk about natural gas gathering, oil gathering, water gathering, and actually pretty much the opposite has been taking place. And we just finished our round of meetings with the gathering companies, the midstream companies. I think we still have one or two that have been really hard to book. But all of them have indicated that it's business as usual in their world. They have rewritten their contracts, so they're actually able to achieve their return on investment based on processing costs and that sort of thing. And so they didn't reduce their budgets for 16, and they're not reducing their budgets for 17. So I think we're still going to have a very good year in terms of gas processing plants, gas gathering infrastructure, and that sort of thing. It's all going to be focused in that core area, obviously, but it should be a good year still.
I don't know if you had a lot of time to research kind of the back half of this question, but I'll ask it anyway. Can you give a definition of what you would call a good well? One with high production rates, and any idea where those are concentrated?
Sure.
County, maybe.
Okay. So the average Bakken well over the last year, as they have focused their efforts into the core, has risen to where the IP rates on them are around 1,200 to 1,500, 1,200 to 1,500 barrels a day. A good well is maybe around 2,000 barrels a day, but we're seeing a significant number of wells in the northeast McKenzie County, northwest Dunn County area that are over 3,000 barrels a day. And those are, I guess I'm going to create another category, really good wells. We're also seeing as Bear Creek begins processing gas, and they've actually started that process. Wild Basin is ahead of schedule. Looks like Bear Creek is ahead of schedule. We're seeing a little bit of shift of capital within the basin from McKenzie County to Dunn County. It looks like some of that area of Dunn County in the northwest corner actually is the place where the really good wells can be drilled. So average well, 1,200 to 1,500 barrels a day. A good well is 2,000 plus, and the really good wells are coming in at over 3,000. And actually, after the flowback, a lot of those are being restricted in production in order to meet the gas capture goals and also preserve cash flow.
Since it may look like a price rebound might take a little bit longer, does that have any concerns for the budget? We do start, for those of you that might not know, we do start a new legislative session in January, so be back to the drawing board on that.
Mm-hmm. Well, I think budget-wise, we've got the production and the price really dialed in very well. I think we've got the rig activity projections and frac activity projections dialed in very well. But I'm hearing that we're still struggling to get sales tax right. And so there are lingering concerns that that the budget, even with the 90% budgets, and we're just about ready to submit ours, the information from OMB is that all of the agencies have really, put their shoulder to the wheel, and they're coming in with 90% budgets and expecting the revenues to be significantly down and state expenditures to be down like that. But I think there continue to be concerns about whether sales tax is going to hold up to reach that number. And so there is yet some work to be done on figuring out where the sales tax came from when all of this activity was going on, and where is it going?
Okay, back to well production. Couple questions here. So are these good or really good wells responsible for keeping production above 1 million barrels a day? And then when you give that IP rate, is that in barrels of oil or barrels of oil equivalent, including gas?
Two good questions. Take the last half first. That's in barrels of oil per day. So that's not in barrel of oil equivalent. So you're really literally looking at a 3,000 barrel a day oil well that's probably producing 4 million to 5 million cubic feet of gas per day. And, oh man, so I made that answer so long, I forgot the first half of the question.
Is at the good well keeping production above?
Sure.
Yeah.
Yeah, so it's interesting to see that they can maintain, that industry can maintain production with only 40 to 45 completions. When it was basin-wide and we were averaging Divide County wells in with northeastern McKenzie County wells, it was taking 80 to 90 completions in a given month to maintain production. So that's just how good these wells are, and that really is the main reason that they're able to stay above 1 million barrels a day, even though they're only completing 40 to 45 wells in a month.
Are break-even prices changed at all? I know last month was particularly low. Are they going to remain that way for a while?
Yeah, the question was break-even prices, they dropped quite a bit last month, and are they going to remain that way? And we think they will. They are based on the most recent quarter's production for wells, and so the wells are getting better, and they're based on the average well cost over the last year, and like I said, we're expecting those well costs to stay about the same, not really go down, not really go up significantly. They're going to go up when activity picks up, but I don't think they're going to go down very much more because all the cutting that can be done has pretty much been done. So yeah, we think those break-even costs will stay there. The difficult thing with them is that all that acreage is held by production, and there's a limited number of companies working in that core area. So you begin to see companies like EOG look around, as they did when they had finished drilling partial on 640-acre spacing, and that's when they jumped to the Eagle Ford and made that giant discovery down there. And now they've looked at the Permian and said, there's potential to take what we learned in the Bakken to another basin and make that work for us. And so they're spending, I think that's a $1.2 billion acquisition to acquire potential in another basin. So those break-even costs should remain low like that, but they're significant just to that core area.
Okay, I am sometimes reading and don't always hear your responses. So someone would like you to clarify, did you say that production was being affected by methane rules? I didn't think I heard that, but...
No, I don't recall saying that. I think I may have mentioned that, and if I didn't, I'd like to, that signals from the Office of Management and Budget in Washington, D.C. are that the BLM methane rule is going to come out by the end of this month. If not, in the early part of October, and that it will change very little from the proposed rule. So on that basis, you can anticipate that to be a big news item when that hits the street, and North Dakota to be very deeply concerned about that.
Okay, been talking a little bit about bringing well costs down, so I'll allow it, but what does a Bakken well cost, and how has that changed in the last couple of years?
The economics that we're seeing presented at the hearings just this last month put the Bakken well costs at between $6.5 and $7.5 million for a completed well cost. That's down from somewhere between $10 and $11 million just 2 years ago. So it's a pretty enormous drop. You're talking 35% decrease. So we're seeing consistently, depending on the part of the basin and the depth the wells have to be drilled to, but between 6.5 and 7.5 million.
Okay, I'd missed one. Are you hearing more about bankruptcies or mergers of companies?
That information has declined recently, so I failed to bring that list with me. But you recall, maybe it was about a year ago, I was talking about where there were 9 or 10 companies on the edge of the cliff. All of them have gone bankrupt since then, and some of them are coming out of bankruptcy. So that's a very large area of activity for our agency, and I continue to get questions from royalty owners and working interest owners about that. We actually went out and hired some outside legal counsel with expertise in bankruptcy to make sure that the state is in the right place when it happens with these companies. Some of the companies, like HRC, spent a lot of time up front preparing for their Chapter 11, and it went through a couple of months and cleared the decks, and they should be in pretty good shape going forward to continue operating one drilling rig and completing some wells. A couple of other companies that there are teams of lawyers fighting over lots of issues, and so it's all across the board. But I think we're seeing the initiation of bankruptcy fall off, but there's going to be lingering impacts.
As of August 29th, there were 84 wells waiting to be transferred.
Yeah, and that's way down.
Yeah,
Our
like
bond administrative assistant says that number should triple in the very near future based on some indications that we've had from some companies.
Dave?
Since you brought up the cost of a Bakken well, do you know how a Bakken well compares to a Permian well?
Yeah, so the question was comparing a Bakken well to a Permian well. And the information that I have is that the Permian wells are maybe $1 million cheaper. So you're looking at a $5.5 to $6.5 million range for wells in the Permian. They also have more targets. I know we have the stacked Bakken and Three Forks, but they've got, in some cases, 6 or 8 shale beds that they're able to extract. So the money has shifted there. They don't have the struggles with weather. And even though West Texas is somewhat a windy place, it's not as windy as North Dakota. And so the weather's more favorable, the shale package is thicker, and the wells are a little cheaper.
Why has well costs dropped so much in the last few years?
The dominant factor has been service companies offering discounts. That's really the big factor. Although the materials going into a well have gotten less expensive, they're using more materials. So we're seeing a lot more cemented liners with plug and perf operations. We're seeing much higher sand loads, much higher water loads for these wells in the core part of the basin. But really the big number in decreasing well costs has been discounts by the drilling companies and the service companies that frack the wells. And that's why we talk about erosion of those savings, because when activity picks back up, in fact, the folks that I talked to in Williston said, you know, they're not going to be able to add frac crews and offer the same price. You know, they absolutely will not be able to offer the same price when they're running 20 frac crews as they're offering today when they're running 5 to 10.
So can well costs come down further? What's the limit on efficiencies and lowering costs?
You know, like we talked about just a few minutes ago, it really appears that the well costs have come down about as far as they're going to go. There might be some ability to make some minor adjustments, and there are some companies that are more efficient than others. But most of the companies that I've talked to recently are typically drilling a 20,000-foot Bakken well in 11 to 15 days. And 3 days out of that are waiting on cement, just so that the wellbore is properly constructed. So I don't know how much more you could reduce that. And really, quite technology-wise, they're pretty much at the end of the game. The rigs walk, so they move them very infrequently. They're drilling a well from spud to TD in less than 2 weeks, and they've lowered the service company costs about as much as they can. So there's not much additional cost cutting to be had.
I have to share this because it's hilarious, but a reporter said that the lack of Tex-Mex food in North Dakota may also play a role in the shift from to the Permian.
To the Permian and Eagle Ford.
Yeah.
Oh boy.
He says,
right.
Just kidding, but the Tex-Mex in Odessa is terrible. So noted, Mr. Reporter, and that was quite funny. Okay, well, that is about all the time we have for Mr. Helms. So
Thanks for coming.
we will let Justin, I think he always does right beforehand. Says, there he is. He likes making an entrance. Tex-Mex in the Eagle Ford, however, is pretty good.
San Antonio, one would think it better be.
We've gotten a few good places here, though, lately. La Carreta, and there's another one on Mandan Street in Bismarck that's supposed to be really good.
When I was out in Williston, actually, it was probably the best. I forget what the restaurant was.
Okay, Mr. Reporter, there are people calling you out saying there is good Tex-Mex in North Dakota, so your theory may not be correct.
Well, it may be important to get that information out there. Stop this capital shift.
Yeah. Okay, JK, you were up.
Well, good morning, everyone. Justin Kringstad with the North Dakota Pipeline Authority. Just going to run through the standard set of updates on the transportation and processing industry in North Dakota and the Williston Basin as a whole. So again, production updates from neighboring states that are impacting transportation and processing in the region. Continued slides in production in both eastern Montana as well as South Dakota. So in both of those areas currently have 0 drilling rigs. I don't see anything stopping that production decline anytime soon.
Bless you.
And when we take a look at what was taking place in July for transportation of crude oil out of the region, we saw some shifts again, and we'll touch on one of the big drivers in the big shift was in truck movements to Canada. And so you'll see in a couple slides that returning back to normal from some abnormally high volumes that we saw in the previous 2 months. If you take a look at the chart on slide 4, again, that bottom green line is one we have been watching the last couple months where we've seen additional crude being trucked north into Canada than the norm. And so again, we don't have a whole lot of answers as to why that was taking place. I know there's a lot of folks looking at that, scratching their heads, trying to get some ideas surrounding it. The timing was such that it was at the same time as some of the wildfires that were taking place in Canada, and so whether or not some of that North Dakota crude was being trucked north to fill some type of market void that was created during that time period. But again, we saw in July those numbers come back to what I would call back in the normal range, what we've seen historically. We saw pipeline market share continue to hold steady and rail uptick as well. But again, likely caused by additional barrels staying in North Dakota and then looking for a market option out of the region versus being trucked as they were the last couple months. When we look at estimated rail volumes on slide 5, again, just a slight uptick in July for those estimates. Again, primarily being reflected on production holding steady, but more barrels remaining in the state versus getting on the trucks. Rail destinations on slide 6, again, pad 1 and pad 5, so the East Coast and the West Coast almost hand in hand now for where that crude oil is headed when it does leave by rail. Another interesting little trend that I'm going to continue to watch here is in the bottom. You'll notice that deliveries to pad 2, which is Midwest, just a slight uptick there as well in market share. And so whether or not we're going to see more and more barrels continue to get down to this more traditional Cushing type markets versus the coastal markets, we'll see if that holds steady or has any more additional movement. Slide 7, taking a look at what refiners are paying in the different pricing markets around the U.S. This is the most recent data available from June. Historic, in the last year or two, these numbers are probably closer than they have been in the past. We used to see pretty large discrepancies between pricing on the East and West Coast versus what was taking place in the Mid-Continent area and the Gulf. When you look at this, everything's within just a few dollars of each other, which is a little bit abnormal from what we've seen over the last several years. When we take a look at pricing as of yesterday and today, just under a $3 spread between that Mid-Continent Cushing price versus Brent or the world oil price. Again, these are the things that marketers are looking at when they're making those decisions of where and how to move their oil out of North Dakota. The truck import, import exports. You can see again that black line, those exports coming down significantly from the last 2 months back into it, closer to those historic norms. Taking a look at flaring, no change June to July as far as the breakdown in the percentage as well as the reasoning for the gas being flared. Again, as you see in orange, the majority of that gas continues to be flared from wells that do have a pipeline connection versus wells that simply aren't connected. Here's a historical look. I'm not sure if I've used this slide at any of the press events, but each month I always show that pie chart, but it just shows you a one-time snapshot. And so this is the historic. If I was to take the pie charts in the last number of months and put them on the same chart, you'll see how this has been trending. So again, that blue portion, the wells that were flaring because they were not connected, continues to decrease as more and more wells get connected. The big challenge continues to be enhancing existing infrastructure in order to get all the gas that's being produced, get those molecules in a pipeline, in a sales system, and move to market. Slide 12, an update on the gas gathering side. And so again, that black line is the number of wells that are getting connected, new wells selling gas in North Dakota, and that is continuing to stay above the pace of new wells coming online. So that's a good sign in making sure that the gas capture industry is staying on top of the production trends and the speed at which new wells are being brought online. And on the gas processing side, just the latest update as far as natural gas liquids being produced. Again, you can see those continue to trend upward. As gas volumes and gas capture continue to increase, we're going to see more and more of these natural gas liquids being processed in the state and needing the transportation method out of the region. So again, this is something that I've been working on a lot the last year. I'll continue to keep everyone updated with what type of developments and projects and what we're seeing and forecasting on that side. So with that, I'd be glad to answer many of the questions that come up. Obviously the Dakota Access situation there, I just want to be upfront that the Pipeline Authority is not a regulatory agency for the state of North Dakota, and so being completely outside of those discussions that are taking place, I've not had any conversations with transfer partners, federal government since any of the rulings last week. So again, I don't really have a whole lot of information on, but I'd be glad to answer any questions that may come up.
And maybe you just want to address the obvious impact is if this pipeline is delayed, what does that mean for transportation in North Dakota?
Right, so as far as pipeline capacity goes, we still would be in the same situation we're at today. So as any type of timelines change with any project, any of the pipeline authority work with the forecasting, with the research that gets done, that just gets updated as more information comes from the regulatory on back to those interested parties.
There was a question about WBI's Dakota pipeline project to connect to Viking. Any idea on the status of that project?
Yes, and so that was a development, the Valley Expansion project. And so this is a system that would connect the existing WBI transmission system in eastern North Dakota to the Viking pipeline system in western Minnesota. And so it would not move North Dakota gas to Minnesota. It would actually be pulling gas from the Viking in Minnesota into North Dakota for consumption. And so again, those communities and that system right now just doesn't have enough capacity to expand in order to meet any type of market growth. And so this was a solution that WBI had come up with in order to, again, address gas supply issues in eastern North Dakota.
Any explanation on why equal amounts of Bakken is being shipped to east and west coast?
It's going to be market driven, so just taking a look at what the pricing is in those different marketplaces. Historically, it was that PADD 1 had some of the higher priced markets. When we look at that trend, that's come back a little bit more in par. So East Coast pricing, West Coast pricing is really what those folks are going to look at, and then what does it cost to get the crude there by whichever method they choose.
Probably the same answer, but maybe not. Expectation on that transportation going forward, more to the east or more to the west?
You know, I don't have any type of forecast for which market share region. Someone had some type of pricing model. They could probably come up with that, but I don't have that information.
Okay, unless you have a comment about Tex-Mex.
You like Tex-Mex.
Yeah. Don't see any other questions. Alyssa, go ahead.
As far as some of the benefits that this active pipeline would bring,
Right, and so as North Dakota's oil production grows, it's going to need additional transportation methods to move that oil. So there's a handful of projects that have been proposed, there's a few that are still on the table. And so as those projects come online, they're just going to add additional capacity and ability to move that crude oil by pipe markets around the U.S.
On the impact controversy with Dakota Access, the impact on future pipelines, and also what happens with Sam Piper, the impact on other projects.
I have not had any conversation with anyone that would indicate any direction on that at this point yet. So.
Have you ever seen or heard this much controversy surrounding the fund?
Well, as far as any major project, whether it was Keystone XL, Dakota Access, again, the interested parties on either side, obviously generating a lot of interest.
Okay. Thank you, everybody.